My name is Rudi Fronk, and I'm co-founder, chairman, and CEO of Seabridge Gold, a role I've played for the past 23 years. When I talk to shareholders, I frequently hear the question, why is gold stagnating when inflation is soaring? That's not what happened in the 1970s. So let's answer that question. The short answer is that markets have great confidence in the Fed. Yes, they kept rates far too low for far too long. Yes, they failed to recognize the initial surge of inflation that resulted. For 10 critical months, they continued their inflationary policies as inflation took off because it was supposed to be transitory. Despite these critical errors, the markets think now that the Fed has it right, that current tightening will work, inflation will be defeated, and the consequences will be a mild recession at most, and maybe not even that. If this is all true, then there is no reason to buy gold. Inflation will subside, the stock markets will come back, and the bond markets will return to normal. Markets think there are better investments than gold. You can call this the Paul Volcker playbook. We've done this before and we can do it again. Let me just say that we believe there's no way that this happens. The circumstances now are nothing like the 1970s. To bring down inflation, Volcker raised interest rates well above the inflation rate and held them there. At that time, total federal debt was about $900 billion, and the debt to GDP ratio was 31%. Today, federal debt is above $31 trillion and sits at about 125% of GDP. Inflation is running at about 7 to 8% now. Can you imagine a 10% Volcker-style Fed funds rate? The Fed is talking about only a 5% terminal rate. Even at 5%, we're in the race between inflation and a deep recession. The Fed will pivot when unemployment begins to rise. We will get whatever inflation reduction the Fed can generate until then. The mass layoffs have already begun, starting in the high-tech industry and soon moving to construction and manufacturing. Last month's average wage increase annualized at about 7%. The rail workers recently got 24% over 3 years. Delta pilots just got 34% over 3 years. The second wave of inflation is upon us. In the 1970s, there were three. Some items go up, some down. But once unleashed, and it has been unleashed, inflation runs until it exhausts itself through recession and unemployment. In short, the Fed won't defeat inflation before we get serious unemployment, a deep recession, and a Fed pivot, as always happens. The dollar will then fall and gold will surge as markets realize there is no early Fed-managed end to inflation, as in the time of Volcker. Meanwhile, the federal government's magical money-eating machine must be fed. The current deficit projection for this year alone is about $3 trillion. The big foreign banks, who own nearly $8 trillion of our debt, are now selling. That includes Japan, China, and the EU. Also, the commercial banks are now selling, as treasuries finish their worst year in history. Commercial banks simply can't afford the volatility. They get a better, safer return parking funds at the Fed. And the Fed is also selling. Who's going to fund the Treasury as tax receipts continue to fall and expenditures climb to offset an economic slowdown? What could possibly go wrong? This is becoming an immediate problem. The Treasury has been running down its checking account to buy time, but that's coming to an end in Q1 of next year. We have no doubt that the Fed will have no choice but to go back to funding the Treasury. Otherwise, yields are going up big and the Treasury market is going into crisis. Treasury interest expense will quickly rise, forcing even more issuances. I like to call this a funding doom loop. Remember how the federal debt went up by more than $6 trillion in 2 years of COVID response? It was mostly funded by a $4 trillion addition to the Fed balance sheet during that period. This pressure to fund the Treasury is only going to get worse. The issue here is a simple one. For decades, the US ran a trade deficit and foreign nations collected up our dollars and bought treasuries. So the US trade deficit financed our budget deficit. Foreigners got a highly liquid security for their savings, and the US got to run twin deficits without any significant consequence. This started to change in 2015 as foreigners became net neutral players in treasuries. Now they are net sellers. Since August of this year, foreign holdings of US debt have fallen by more than $300 billion. Sanctions against Russian holdings of dollar reserves have not helped. Liquidity in the treasury market is becoming defaulter. Janet Yellen even admits this herself. What will happen when the Fed resumes financing the Treasury? Simply put, gold will fly. When my colleagues and I formed Seabridge in October of 1999, our goal was to create the industry's best leverage play to a rising gold price. And as you can see, over the long haul, we've delivered on that. When we formed the company in 1999, the gold price was about $260 an ounce. Today, it's about $1,800 an ounce, up nearly 500%. But during that same time period, our share price is up over 6,000%. How have we created this optionality and leverage? Simply by growing ounces in the ground faster than shares outstanding. The thought was that the more gold we can provide on a per share basis, the better our share price should do in a rising gold price environment. If you look at Seabridge today relative to the industry, we provide far more gold ownership in terms of reserves per share or resources per share compared to any other company on the planet. Simply put, if the gold price is going to go higher, like we think it is, or you simply just want to have some exposure to gold in a balanced portfolio, Seabridge has a 23-year track record of outperforming gold and other gold equities. If gold is going higher, so is our share price. Thank you for your time today, and I look forward to meeting with you again soon.